Warren Buffett just did something he's never done in 60 years of investing. On November 2nd, 2025, Berkshire Hathaway reported a cash pile of $381.7 billion. That's not a typo. Nearly $400 billion sitting in cash and treasury bills, earning a steady 5%, while the rest of Wall Street chases artificial intelligence stocks at record highs. Think about what this number actually means. Buffett's cash position is now larger than the entire market capitalization of Coca-Cola, Disney, and Nike combined. It represents 31% of Berkshire's entire portfolio, just sitting there, collecting interest. For context, Buffett has historically kept only 5 to 10% of his portfolio in cash. This isn't normal, this is unprecedented, but here's where it gets really interesting. This isn't a recent decision. Buffett has been methodically selling stocks for 10 consecutive quarters, from early 2023 through the end of 2025, 10 straight quarters of selling, not buying. In the third quarter of 2025 alone, he sold $6.1 billion worth of stocks and bought exactly 0 new positions. When you've built your reputation on finding undervalued companies and holding them forever, selling everything for nearly 3 years sends a very clear message. The selling spree tells an even more dramatic story when you look at specific positions. Remember, Apple was once 50% of Berkshire's entire stock portfolio. Buffett called it his best business outside of insurance. Since 2023, he sold over $100 billion worth of Apple shares, cutting the position to roughly 30% of the portfolio. That's not trimming around the edges. That's a fundamental shift in strategy. Bank of America received similar treatment. Throughout 2024 and 2025, Buffett dumped over $10 billion in Bank of America shares, despite being one of the bank's largest shareholders for over a decade. These aren't companies facing scandal or declining fundamentals. These are blue-chip stocks at or near all-time highs that Buffett simply doesn't want to own anymore. Then came November 12th, 2025, when Buffett made another announcement that shocked the financial world. He's transferring $149 billion of his wealth to his children, and stepping down as CEO at the end of 2025, Greg Abel, his chosen successor, takes over Berkshire Hathaway in 2026. At 95 years old, Buffett isn't just hoarding cash. He's preparing for succession during what appears to be a major market transition. Perhaps most telling is what Berkshire didn't do in 2025. For the first time since 2018, the company conducted 0 share buybacks. This is significant because Buffett has always said that when Berkshire's stock trades below intrinsic value, buying back shares is the best use of excess cash. If he's not even buying his own company's stock, what does that tell you about his confidence in current market valuations? Our cash hoard is now earning over $19 billion per year in risk-free income from treasury bills. That's more than the annual profit of most Fortune 500 companies, generated without owning a single share of stock. While everyone else chases the latest artificial intelligence darling or meme stock, Buffett is content collecting 5% on nearly $400 billion in government-backed securities. This cash position represents the largest corporate cash pile in American history. It's 3 times larger than Buffett's previous record cash position in 2020. When the greatest investor of our time accumulates this much firepower while systematically selling everything else, you should pay very close attention to what comes next. The Oracle of Omaha has built his fortune on a simple principle: buy when others are selling, sell when others are buying. Right now, everyone is buying artificial intelligence stocks trade at 50 to 100 times earnings. The S&P 500 sits at all-time highs, despite rising interest rates and slowing economic growth. Meanwhile, Buffett is selling everything and hoarding cash at levels never seen before in corporate America. When you combine the record cash position with his succession planning and complete withdrawal from share buybacks, a clear picture emerges. Warren Buffett isn't just being cautious. He's positioning Berkshire Hathaway for the biggest buying opportunity in decades. The question isn't whether he sees trouble ahead. The question is whether the rest of us are paying attention to what $381.7 billion in cash is trying to tell us. Here's what should grab your attention. Warren Buffett has done this before. Every time he's hoarded massive amounts of cash, markets have crashed within 12 to 18 months. This isn't coincidence. This is pattern recognition from someone who's witnessed every major market cycle since the 1950s. Let's travel back to 1999, during the height of the dot-com bubble. While everyone else was pouring money into internet companies with no profits, Buffett was quietly building cash. By late 1999, roughly 20% of Berkshire's portfolio sat in cash and treasury bills. The financial media mocked him relentlessly. Buffett doesn't get it, they said. He's missing the new economy. Technology is the future. Sound familiar? The parallels to today's artificial intelligence bubble are striking. In 1999, companies like Pets.com traded at astronomical valuations despite never turning a profit. Today, AI companies trade at 50 to 100 times earnings based on promises of future growth. Different technology, same euphoria, same willingness to ignore fundamental valuations. March 2000 arrived with brutal clarity. The Nasdaq peaked at 5,048 on March 10th, then began a devastating collapse that lasted 2 years. By October 2002, the index had fallen 78% from its peak. Companies that seemed unstoppable in 1999 simply disappeared. Pets.com, which went public at $11 per share in February 2000, was liquidated by November of the same year. But here's where Buffett's cash strategy proved brilliant. While everyone else watched their portfolios evaporate, he deployed his cash reserves to buy incredible companies at 50% discounts. Throughout 2000 and 2001, he purchased stakes in businesses that would generate massive returns over the following decades. The cash that seemed foolish during the bubble became the foundation of extraordinary wealth creation during the crash. The pattern repeated in 1987, though most people don't remember the setup. Throughout the mid-1980s, Buffett had been steadily raising cash as markets climbed higher. By the summer of 1987, roughly 30% of Berkshire's portfolio consisted of cash and short-term investments. Again, critics questioned his strategy. The bull market seemed unstoppable. Why hold cash earning 5% when stocks were rising 20% annually? October 19, 1987, provided the answer. Black Monday arrived like a financial earthquake, with the Dow Jones falling 22% in a single trading session. Panic selling created opportunities that hadn't existed since the Great Depression. Companies with strong fundamentals suddenly traded at bargain prices as investors fled to cash. Buffett was ready. In the months following Black Monday, he deployed his cash reserves strategically, with his most famous purchase being Coca-Cola. Between 1988 and 1989, he accumulated a massive position in Coca-Cola at an average price of about $10 per share, adjusted for splits. That investment, purchased during market panic with cash accumulated during market euphoria, eventually became worth over $25 billion, a 50 times return generated by having cash ready when everyone else was selling. The 2008 financial crisis showcased Buffett's cash strategy at its most sophisticated level throughout 2007. As housing prices soared and banks leveraged themselves to dangerous levels, Buffett accumulated over $40 billion in cash. This was a record at the time, though it seems small compared to today's $381.7 billion position. He refused to buy bank stocks or real estate companies, despite pressure from analysts who thought he was missing opportunities. When Lehman Brothers collapsed in September 2008, triggering a global financial panic, Buffett transformed from conservative cash hoarder to aggressive dealmaker overnight. In a span of 6 weeks, he deployed billions in structured deals that would have been impossible without massive cash reserves. He invested $5 billion in Goldman Sachs, receiving both equity and preferred shares yielding 10% annually. He put $3 billion into General Electric under similar terms. He negotiated a $5 billion investment in Bank of America that included warrants to purchase common shares at favorable prices. These weren't typical stock purchases. These were crisis-driven deals with terms that only someone with enormous cash resources could negotiate. Buffett's Goldman Sachs investment alone generated over $3 billion in profits. His Bank of America position, executed when the bank desperately needed capital, eventually became worth over $35 billion. The $40 billion in idle cash became the foundation for some of the most profitable investments in Berkshire's history. But Here's where 2020 reveals something important about Buffett's evolution as an investor. When COVID-19 crashed markets in March 2020, Buffett had accumulated $128 billion in cash. The S&P 500 fell 35% in 3 weeks, creating the kind of buying opportunity that should have triggered massive deployment of capital. Instead, Buffett largely sat on his hands. During Berkshire's 2020 annual meeting, he explained his restraint. "We haven't done anything because we don't see anything that attractive to do." Even after a 35% market crash, valuations didn't reach levels that excited him. This proved prescient as Federal Reserve money printing and government stimulus inflated asset prices to even higher levels throughout 2020 and 2021. Now fast forward to 2025, and the pattern becomes unmistakable. Buffett's current $381.7 billion cash position is 3 times larger than his 2020 position, and nearly 10 times larger than his 2008 position. He's been selling stocks for 10 consecutive quarters, the longest streak in Berkshire's history. He's refusing to buy back his own company's shares, something he's always done when he believed they were undervalued. The mechanism behind this pattern isn't market timing in the traditional sense. Buffett doesn't try to predict when markets will crash. Instead, he recognizes when markets become overvalued relative to underlying business fundamentals. When quality companies trade at reasonable prices, he buys and holds. When those same companies become expensive relative to their earnings potential, he sells and accumulates cash. The cash serves 2 purposes. It generates safe, steady returns through treasury bills and short-term bonds, and it provides massive buying power when market crashes create once-in-a-decade opportunities. This isn't speculation. This is systematic value investing executed with extraordinary patience and discipline. Looking at the timeline, the pattern becomes undeniable. In 1987, cash accumulation preceded Black Monday by months. In 1999, cash buildup preceded the dot-com crash by a year. In 2007, cash hoarding preceded the financial crisis by 18 months. In each case, Buffett's cash position peaked before markets crashed, providing the firepower needed to capitalize on the resulting opportunities. Today's $381.7 billion represents not just the largest cash position in Berkshire's history, but the largest corporate cash position in American history. If the historical pattern holds, and Buffett's 6 decades of experience suggest it will, our markets are approaching a buying opportunity that could dwarf even the crashes of 1987, 2000, and 2008. But here's what makes 2025 different from every previous cycle. The setup is worse than anything Buffett has seen before, and he knows it. While the S&P 500 hits record highs daily, and artificial intelligence stocks soar to unprecedented valuations, the greatest investor of our time is systematically exiting the market at levels that suggest he sees something the rest of us are missing. Let's examine the evidence that makes today's market more dangerous than the dot-com bubble or the 2008 financial crisis. According to Federal Reserve data, corporate debt now exceeds $10 trillion, significantly higher than pre-crisis levels in 2008. Yet companies continue borrowing to fund share buybacks and dividend payments, while their underlying businesses face slowing growth and margin pressure. The artificial intelligence bubble has created valuations that make the dot-com era look conservative. NVIDIA trades at over 50 times earnings, despite generating most of its revenue from a technology that's still in experimental phases. Compare this to Cisco in 1999, which traded at similar multiples but had established revenue streams and proven business models. Today's AI companies are priced for perfection in markets that rarely deliver perfection. Meanwhile, the Federal Reserve maintains interest rates above 5%, the highest levels since 2007. This creates a dangerous dynamic where companies face rising borrowing costs while investors demand increasingly higher returns to justify holding risky assets. When rates were near zero from 2009 to 2022, expensive stock valuations made sense relative to bond yields. With Treasury bills now yielding over 5%, the risk-reward calculation has fundamentally shifted Buffett's actions. During this period, reveal someone who understands these dynamics better than almost anyone alive. From 2023 through 2025, he's been selling stocks while markets climbed to record highs. This isn't the behavior of someone who believes current valuations are sustainable. This is someone positioning for opportunity amid what he clearly sees as dangerous market conditions. Consider his Apple sales in historical context. Apple wasn't just Berkshire's largest position. It represented Buffett's evolution as an investor, willing to embrace technology companies. He called Apple probably the best business I know in the world, and compared holding Apple shares to owning a farm or apartment building. Yet since 2023, he's sold over $100 billion worth of Apple shares while the stock continued reaching new highs. The Bank of America sales tell a similar story. Buffett has been one of the bank's largest shareholders since investing $5 billion during the 2011 financial crisis. That investment generated massive returns as the bank recovered and grew throughout the following decade. Yet throughout 2024 and 2025, he methodically sold over $10 billion in Bank of America shares, reducing his stake significantly even as the bank reported strong earnings and improved capital ratios. What's particularly telling is the timing of Buffett's succession announcement on November 12, 2025. At 95 years old, he's transferring $149 billion to his children and stepping down as CEO, with Greg Abel taking over Berkshire in 2026. This isn't coincidence. Buffett has structured the transition so that his successor inherits the company during what he clearly anticipates will be a period of market turmoil and exceptional buying opportunities. The numbers support this interpretation. Buffett's $381.7 billion cash position generates over $19 billion annually in risk-free income from Treasury bills. That's more than the annual profits of companies like McDonald's, American Express, or Home Depot. He's created a machine that produces billions in cash flow without owning a single share of overvalued stock. Meanwhile, retail investors continue pouring money into the same artificial intelligence and growth stocks that Buffett is avoiding. According to investment company Institute data, equity mutual fund flows remain strongly positive throughout 2025, with investors chasing performance in the exact sectors where valuations have become most stretched. This mirrors the late stages of previous bubbles, when ordinary investors become most optimistic just before markets collapse. The disconnect between Buffett's actions and broader market sentiment couldn't be more stark. While he accumulates cash at record levels, popular investment apps report record user activity and options trading volumes. Social media platforms overflow with stories of overnight millionaires created by artificial intelligence stocks and cryptocurrency gains. Everyone is greedy, which brings us back to Buffett's most famous advice. Be fearful when others are greedy, and greedy when others are fearful. History suggests who wins and loses when this pattern resolves. In 1999, retail investors who held technology stocks through the crash lost 80% of their investments. In 2008, homeowners and bank shareholders faced similar devastation. But investors with cash during those periods, particularly those who could deploy capital during maximum panic, generated life-changing returns. Buffett's track record during market crashes speaks for itself. His 1988 Coca-Cola purchase generated 50 times returns. His 2008 crisis investments in Goldman Sachs and General Electric produced billions in profits. His current cash position is nearly 10 times larger than his 2008 war chest, suggesting he anticipates opportunities that could dwarf even those legendary trades. Warren Buffett is 95 years old. He's survived and profited from every major market crash since 1950. He's built the most successful investment track record in history by recognizing patterns that others miss and having patience to wait for extraordinary opportunities. In 1987, he accumulated cash and bought Coca-Cola at the bottom. In 2000, he avoided the dot-com bubble and deployed capital after the crash. In 2008, he had $40 billion ready and generated massive profits from crisis-driven deals. Now, in 2025, he holds $381.7 billion in cash, the largest corporate cash position in American history. He's been selling everything for 10 straight quarters, refusing to buy his own company's stock, and stepping down as CEO. This isn't retirement planning. This is preparation for the biggest buying opportunity in decades. The cash pile doesn't lie. When the greatest investor of our time abandons the market with nearly $400 billion in firepower, The question isn't whether a crash is coming. The question is whether you'll have cash ready when it arrives, or whether you'll be selling to Warren Buffett at 50 cents on the dollar.